whereas ICDS requires that the same is to be converted into reporting currency using the exchange rate on the date of transaction. That means if I have some inventory or some current investments denominated in foreign exchange, I need to convert the year-end balance using the same rate which prevailed on the date of purchasing the inventory or making the investments. That means once again, there is a requirement of creation of deferred tax asset or deferred tax liability as the case may be. Then this is for revenue, non-monetary items of revenue nature. Then comes non-monetary items of capital nature. Suppose I have imported some fixed asset, machine. Then this ICDS will not apply because section 43 capital A contains a clear provision which I have just referred to. But in case you made an external commercial borrowing, obviously that is in foreign exchange, and with that foreign currency loan you have acquired an asset in India. In that case ICDS will apply, capital non-monetary items. Now let us find out what our institute standard says, AS11. AS11, para 46A gives me two options. Either you take it, exchange difference, you take it to profit and loss account, or if you want, you can capitalize. Two options are given to buy piece from industry because they don't want to burden their profit and loss account. In that case, section 43A will not apply because there was an external commercial borrowing, foreign currency loan, but the asset was not imported. Asset was acquired in domestic market. Therefore, 43A will not apply. That's why ICDS comes out with a new idea. It says that this exchange difference in respect of such foreign currency loan is to be recognized as loss or income. That means I obtained a loan of US dollar 10,000 and that US dollar 10,000 was used by me for acquiring a machine in India, in the domestic market. I did not import. Suppose at the time of taking the loan, dollar rate was 60. So 10,000 into 60, which comes to 6 lakh rupee value of foreign currency loan. And during the year, I have paid 5,000 US dollars, and at the end of the year, there is 5,000 US dollars still outstanding when the exchange rate went up to 63. This 3, whether I can claim. Under normal circumstances, I cannot dream of claiming this exchange loss because it relates to capital item. I cannot claim it as a revenue loss, whereas ICDS is allowing you. I don't know consciously or unconsciously. This is against the settled principle laid down by the Supreme Court that exchange loss related to capital items shall not be allowed as deduction because it is capital in nature. Exchange gain relating to capital item shall not be taxed because it is a capital receipt. And there are a lot of cases. Most important case was the Tisco's case reported in 231 ITR. Next, government grants. Government grants, okay, there is nothing much here, but one or two issues which should be noted because these government grants, this standard will also apply to charitable institutions who may be receiving government grants. And the form of government grants may be anything, subsidies, cash incentive, duty drawback, reimbursement of any loss, etc. But it does not deal with other government assistance, say participation of the government in your equity shares. No. Now, one problem is there, two conditions are there. That government grant should be recognized where there is a reasonable assurance that if any condition is attached to the grant, that condition will be complied with, and there is no problem regarding certainty of realization of the grant. Second condition, that under no circumstances you can postpone recognition of the grant once you have received it. There appears to be certain conflict between these two requirements. If I receive the grant with a condition that that you have to acquire one asset, say within a period of 1 year from the date of receipt or 6 months, and I fail to comply with that condition, in that event, I have to refund the amount of grant. Under normal circumstances, as per generally accepted accounting principle, unless and until I fulfill that condition, I will continue to keep that amount as liability. Here say that once you receive, you cannot postpone the recognition of such grant. So it will be offered to tax if it is revenue grant, and if it is to be reduced from related asset, if it is a capital based grant. And grants relatable to depreciable capital assets. Provision is there in ICDS, but it was not necessary because explanation 10 to section 43(1) clearly takes care of such situation, that if I receive some subsidy grant from government against any asset or a number of assets, then it is to be adjusted against all the assets on a suitable basis. Now, grants relatable to a non-depreciable asset. Then there is a problem. It says, suppose I acquired a land and against that land I got a subsidy, say reduction in price. So I acquired the land at 10 lakhs and government paid me a subsidy of 2 lakhs towards that land. Normal accounting principle says what? In the balance sheet I will carry it at 8 lakhs. Or 10 lakhs on the asset side, capital reserve 2 lakhs. But here it says that grant relatable to non-depreciable asset should be recognized as deferred income over a period matching with costs to be incurred for meeting the related obligation. It is not understandable to me only. If I receive a grant against a non-capital asset which is not depreciable, obviously it is land. How can it be treated as an income? Then again that basic issue arises. If the receipt does not have the characteristic of income under the Income Tax Act, whether ICDS can override that particular view. ICDS 8, securities held as stock in trade, then only ICDS 8 will apply. Only one issue, two issues. One is derivative. Now, securities is defined under Securities Contract Regulation Act, and as per that act, the word security does not include derivatives. Now, if derivatives are held as stock in trade, whether it should be governed by ICDS 2, because ICDS 8 cannot apply, because securities do not include derivatives. So, there is a doubt. And it says that securities are to be recognized at cost if it is held as stock in trade, and if the NRV on the balance sheet date is less than your cost, then it can be valued at NRV, but the comparison of actual cost and NRV, that is to be done category-wise, not script-wise. And this may give rise to a possibility that you are paying tax on unrealized income also. Unlisted securities or securities which are not regularly traded, thinly quoted they call, that should be taxed, valued at actual cost, irrespective of NRV. No sense. These securities are held by me as my stock in trade, inventory. Maybe it is an unlisted company. And I know that balance sheet shows losses year after year. It might have negative net worth, but it should be continued to be valued at cost if it is unlisted. And FIFO method is prescribed. You cannot follow average method as method which is permitted under AS 13. And I'm skipping borrowing cost. Borrowing cost, only point is that in this ICDS 9, it says qualifying asset includes land also. Okay, so borrowing cost in relation to land should be capitalized. But up to which portion? Obviously, before the land is put to use. But that is not necessary. It is already provided in section 36(1)(3). There is a proviso that if any asset is, any interest on loan is incurred, and if the loan was taken for the purpose of any new business or new industrial undertaking, then interest up to the date when the asset is first put to use shall not be allowed. That means it will be added to the cost of the related asset for the purpose of depreciation, etc. Here it says that qualifying asset should include land also. Now, if the land, there is one issue. Suppose the land was acquired by me not for the purpose of new business, not for the purpose of expansion of my existing business. I acquire a land only for the purpose of, say, creating a branch office there or additional head office. There is no new line of business, no expansion. Whether interest on such loan is really allowable under 36(1)(8)? Answer is yes. Because interest on borrowed capital is to be allowed if the borrowed capital satisfies the user test, that it is used for the purpose of business, without distinction between whether the loan was used for financing capital expenditure or financing revenue expenditure. Only in case of new project or expansion of project, extension of business, that 36(1)(3) says that interest from the date of obtaining loan to the date when the asset is first put to use shall not be allowed. But here it appears that any interest on loan which was used for acquiring a land is not going to be allowed, irrespective of the fact that the land was acquired for your existing line of business. And contingent liability provisions, contingent assets, they have come out with standards. My only concern is that we also have difficulty interpreting the standards, accounting standards. Sometimes we take opinion from experts. We attend seminars like this to understand, to have more clarity. Take the case of assessing officers. They have to interpret the standards. I will conclude with an example regarding the interpretation of the term provision. The definition of provision is there. That definition is more or less same as given in AS 29. That provision refers to a liability which is to be ascertained by a fair degree of estimation is required. That was a matter under section 263. The assessing officer found, assessing officer did not consider much about that item. Notes on account of that company, there was a disclosure. It's a public sector company. Because you know the public sector, this charter of demand is negotiated every 4 years. So the earlier charter of demand has expired, and the year was financial year 2019 when the next negotiation had reached advanced stage. And finally, negotiation was signed by the government. I mean, final charter of demand agreement with the unions and associations was signed by the ministry in 25th April or 26th of April of the next year. So, as on 31st March 2009, the company could fairly estimate, most reliably, on a reliable basis, the estimate of say 80 crores was made towards arrear salary, because it is to be given effective from the back date. The Commissioner on Income Tax, obviously, once again, though it is not officially known to us, but it is certain that Revenue Audit raised an objection that you have allowed a deduction on account of a contingent liability. And Commissioner of Income Tax does not normally fight with the Revenue Audit Department for the reasons best known to them. So the Commissioner initiated proceeding under section 263. That 263 order is under challenge before the tribunal. In the meantime, the assessing officer has to give effect by passing a consequential order in pursuance of the direction from the Commissioner. The assessing officer did not admit that it can be a provision. It is a provision for a clear liability. It is not a provision for contingent liability. Negotiation reached advanced stage, and the final agreement was signed by the ministry on 25th of April, and the accounts were signed in May. So he said that it is not a provision for a clear liability. No expenditure was really incurred. He never thought that the services were rendered by the assessee over last 4 years. It is a past service cost. So why I am citing this example? So they have to interpret first. And before that, this Revenue Audit Department prompted the assessing officers to initiate 147 proceeding, prompted the Commissioner of Income Tax to initiate this revision proceeding under section 263. I think Revenue Audit should also be trained for proper interpretation of ICDS issued by the department. Thank you very much for patient listening.